There's no need to panic. The 10-year, 2-year spread was bound to invert eventually. But why did the Fed wait until the end of 2016 to hike interest rates? Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button. Today, we're going to be talking about the U.S. economy, the Federal Reserve, interest rates, 10-year, 2-year spreads, and what that means for the future. Are we about to enter another recession? These are the questions people are asking. They're worried about the 10-year, 2-year spread. This is the difference between the 10-year Treasury and the 2-year Treasury. Usually, the longer out you go in terms of a bond, 10 years versus 2 years, the interest rates tend to be higher. And when they're not, then you call it an inversion. And this usually is a flashing light that indicates that a recession could be on the horizon. Whenever the 10-year, 2-year inverts in recent history, usually that means you're going to see a recession about 16 months later, sometimes longer, sometimes less. But sure enough, it's a pretty solid indicator. I tend to subscribe to it. I think we're ending the end of the business cycle. And so it's not surprising that you would see the inversion and then that we might see a recession. It's been 12 years since the last inversion. It's been about 10 years since the last recession. And usually we average a recession once every 5.3 years, according to U.S. Bureau of Economic Analysis data since the end of World War II. So this is really not surprising, but you're going to see some finger pointing going on. Democrats are going to want to say, oh, the economy's tanking, and so that's Trump's fault. He's the incumbent, so they're going to run against the economy. Republicans are going to look at indicators like the very low unemployment rate, and that's all well and good. I mean, we're definitely at full employment, 3.7%. That's really good. I mean, you have to go back like 50 years to see the last time unemployment was that low. And it's a good indicator. I think that you want to see the unemployment really low. We've created more than 5 million jobs, the U.S. economy, since President Trump took office. And so everyone likes to see a really strong economy. 2.9% in 2018 was the strongest economic growth we've seen since 2005. It was even better than 2015. And so I think that Republicans, they're going to have a lot of good things to talk about next year as President Trump enters his reelection bid. And so, leaving aside the partisan politics, I think we are ending the end of the business cycle. And so the 10-year, 2-year was bound to invert eventually. Now, sometimes you get false signals. If you had asked me in the winter of 2016, I would have told you that and I did, that I thought the economy was about to crumble. You saw then the oil prices were getting really low, $26 a barrel. S&P was testing its support levels. China was undergoing a major correction at the time, and there was a huge drop in the Chinese stock market at the end of 2015, the beginning of 2016. And then you saw a big correction on U.S. equities markets. And the 10-year Treasury was dropping throughout 2016. So a huge drop at the beginning of the year, and then all the way until the beginning of July, when it got down to a decades low of 1.36%. And so if you'd asked me then, I would have said, oh, wow, you're basically on the cusp of the next recession. But the timing was off. Certain things had not happened yet. And one thing I should have been paying attention to at the time was the 10-year, 2-year spread. Now, the 10-year, 2-year spread it did start to really go down at the beginning of 2016. And it got as low as 0.76, and right around the same time the 10-year Treasury was reaching its bottom. But for, I think, the Federal Reserve, we might have already seen the next recession. And I think in terms of policy normalization, in terms of the Fed coming off of its 0% interest rates that happened after the financial crisis, in 2008 and 2009, the Federal Reserve started doing quantitative easing, but what they also did was bring the federal funds rate down to practically 0%, and it left it there all the way until the end of 2015 when it did a quarter percent interest rate hike, and that corresponded with the markets tanking. So the Fed was saying, oh, we're going to start raising rates, and markets panicked overseas everywhere, the United States, and there was a flight to safety. And then they put the brakes on. They started policy easing in December of 2015. But by the time you got to July, they were saying, no, we're not going to raise interest rates anymore. And then they waited until after the 2016 election when on December 14th, they started the interest rate hiking cycle. Now, I've argued in the past they should have started hiking back in like 2014 or 2015. And if so, we would probably have already seen the next recession. Alas, they didn't do that. And here we are where we are. You could argue that they timed the politically. They were held off until after 2016 to do the rate hiking. Well, if they'd done it beforehand, that would have been happening on the Obama economy's watch, and that might have favored Republicans in the 2016 election. So by waiting, was it politically timed to help Democrats win? You can be the judge of that. You'd have to ask Janet Yellen why they waited so long to hike interest rates. But you do see a correlation between the 10-year, 2-year spread and the federal funds rate, such that when the Federal Reserve is doing its hiking, when it raises the federal funds rate, the 10-year, 2-year spread seems to respond, and you get closer to inversion. And that's certainly what happened in the most recent cycle, where as soon as the Federal Reserve started hiking, the 10-year, 2-year spread, which was already kind of low, started marching downward. So it seems to indicate that the Fed can time a recession if it wants. It can raise the federal funds rate and cause a recession on the spot, or within a predictable course of time. And so we are where we are, though. You might not see a recession for 16 months after now, which would bring it all the way to December of 2020. So potentially they've forestalled a recession until after the next presidential election. For President Trump, he might not have to worry about, for example, the unemployment rate rising dramatically, which tends to happen during the recession. So you might, if the prediction is correct, and you might see unemployment start to rise towards the end of next year, or even into 2021. Now, leaving that aside, all we can do. We can't argue what the counterfactual would have been had the Fed started hiking rates back in 2015 or 2014, and if they'd done it much sooner. But all we can do now, perhaps, is prepare for the next recession and what that means, and see where we go from here. Former Federal Reserve Chairman Alan Greenspan, he's saying that there's no barrier for Treasury yields to fall below zero. Here he's talking up the possibility of negative interest rates. And you can find negative interest rates around the world. 2016, when we saw 10-year rates collapsing here, well, 10-year rates in Japan, they were collapsing too. Europe started to see these interest rates go negative. And what does that mean for the future of the U.S. economy? Greenspan's saying the U.S. Treasury yields, they could go negative. Well, interest rates are a symptom. They're an indicator. They tell you what's going on in the economy. So lower interest rates over the course of time tend to correspond with periods of slower growth. Nominally, higher interest rates, and they also are indicative of monetary policy. You had higher interest rates in the 70s and the 80s, and you also had higher nominal growth. So the higher interest rate, that was indicative of a weak dollar, and the super low interest rates we're seeing now, that's indicative of a stronger dollar. And with the stronger dollar, we've seen feedbacks into international trade. When China is devaluing, they're trying to boost their exports. When we have a strong dollar, we're going to probably engage in more outsourcing. You might see lower labor participation. And these are trends that we've seen play throughout history. In the Great Depression era, this is a paper from Barry Eichengreen and Jeffrey Sachs. They looked at what the effects of countries coming off the gold standard were on competitors. And they write, quote, in all cases of unilateral devaluation, currency depreciation increases output and employment in the devaluing country. And it tends to do the opposite in the other countries that wait to devalue. So the United States didn't start devaluing until coming off of the interwar gold standard until 1933, and by then the unemployment rate was already up to 25%. Had they acted sooner to pay attention to what the UK and other countries were doing at the time, it's possible that unemployment would have never gotten up to 25%. Alas, economists and policymakers were less aware of what the effects of competitive devaluation could be. President Trump has been paying attention to China currency. He talked about it in 2016 when he was running for president, and he thinks the dollar is too strong. On August 8th, he wrote on Twitter, quote, as your president, one would think I like a strong dollar, but I don't. The Fed's high interest rate level in comparison to other countries is keeping the dollar high, making it more difficult for our manufacturers to compete. So what happens if the dollar is too strong is it makes the price of U.S. exports higher than and if China is devaluing, it makes the price of their exports to us cheaper. So it gives them a competitive advantage. And so the president wants to talk about monetary policy. And so he's wise, I think, to continue talking to the Chinese with the trade deal. He's forestalled doing the 10% tariffs on the remaining $300 billion of goods. We're at 25% tariff on the $250 billion of goods. And he's saying we're going to hold off on the tariffs. He's going to wait till December and give it more time to play out. He says on August 14th, quote, good things were stated on the call with China the other day. They are eating the tariffs with the devaluation of their currency and pouring money into their system. The American consumer is fine with or without the September date for the tariff increase, but much good will come from the short deferral to December. It actually helps China more than it helps us, but this will be reciprocated. Millions of jobs are being lost in China to the other non-tariff countries. Thousands of companies are leaving. Of course, China wants to make a deal, let them work humanely with Hong Kong first. So here Trump is talking about China and Hong Kong policy, and he's giving them a little bit of a reprieve on the increased tariffs. And certainly the tariffs are having an impact. The trade and goods deficit with China was down 10% the first half of 2019. That's $19 billion. So you're seeing an impact where China's having slower growth now. They're having fewer exports to the United States, and this is going to hit them economically. So Trump understands these what the impact of these policies can be, and so he's been trying to leverage China with the higher tariffs to try to get a trade deal, and it might work. This could bring China to the table, and we certainly hope so. I don't think anyone wants to see a full-on trade war. I think we'd like to see an agreement. And we can reach some equilibrium vis-a-vis the dollar and the yuan. I think that we need to come to some sort of trade deal that includes a monetary component or just an international monetary accord that's going to say that countries are not going to devalue to try to get an unfair advantage over the United States. I think that that's going to have to be the heart and soul of any trade deal with China, the only way to resolve this. And so I'm concerned about the higher dollar too. Having a strong currency is a choice. It didn't help during the Great Depression when the federal government stuck to the interwar gold standard while the rest of the world was abandoning it as unemployment spiked in the U.S. My thinking is nobody's talking about negative interest rates, though, as a solution if the dollar isn't so strong. So Trump is wise to continue the talks with China because we need to resolve the monetary issue before events shift beyond either Beijing or Washington, D.C.'s control, and only bad choices are presented to us. And so I think that the 10-year, 2-year, that's going to kind of take care of itself. If we see another recession, it could be, we certainly have seen the probability increase now that the 10-year, 2-year is inverted. but you might not see it until after the election, maybe before. It's hard to say. It's really difficult to time these things. And I think the Federal Reserve, they have a little bit of explaining to do of why they waited so long to raise interest rates. It seems like every other president has to deal with an interest rate hike, except for former President Barack Obama. He got 0% interest rates the whole time. And so the next president was always going to have probably this happening, whether it's before 2020 or afterwards. I guess we'll see. But I'll leave you with the close here. I think this is an interesting discussion. You should be paying attention to these economic developments, whether you're a political junkie or you're trying to pay attention to your investments, your retirement savings. So here's the end. All of these factors could very well weigh on the economy, but there's no need to panic. Every recession is different, and the next one may not hit until after the 2020 election is all over with. We'll see. We've been here before, and I suspect we'll survive it. But with talk of negative interest rates or policies like universal basic income in the wake of the next downturn, what we need to make certain of is that liberty, limited government, and capitalism survive as well. That's the commentary. This is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button, ring the bell for notifications, and have a good day.